Good morning. This is the Saxo Bank Market Call for Monday, September 17th. And we've had a pretty interesting close to last week. We had this a couple of weak U.S. data points. Thursday, the CPI missing quite badly relative to expectations. And then Friday, a weak retail sales report. And this had the dollar on the defensive into late Friday. But then we saw the U.S. dollar snapping back to the strong side. I think the key factor here was bond yields, which really, with the whole U.S. yield curve lifting, pretty much ignoring that weak data. If we look at a chart here, I've got a euro dollar where we saw it pushing up into that 117 area, and even above, there was a minor high around 117.33. There's a key resistance zone. We were actually a little bit bearish on the dollar heading into that data point if the dollar managed to stick a weak close for the week, and it didn't manage to do that. And we do have the next chart here is of the U.S. Treasury note. Kim, on the technical side, we're looking at this, these, of course, the 3% level is what people are looking at in yield terms, but here it's pretty similar to the low 119s.
Yeah, it's correct, 3%. 119 on the actual future, the T-note future. It seems like, and to me it seems like it could break it, and then we're talking about 118.10 is a level. There's a little bit of support there. Don't see it that strong, but a little bit bounce off, but it looks really weak at the moment.
Yeah, I think bonds look really heavy. And Ola, on the positioning front, you of course track these weekly positioning reports, leveraged funds, speculators, etc. So we still see this massive structural treasury short by leveraged funds.
Yeah, if we look at the chart here, we can see that we've basically got a record short if you take the long end contracts from 10-year notes all the way out to ultras. And it's basically been occurring while we've been almost range bound in T-notes here for the past 3 to 4 months between 280 and 3. So again, they're looking for higher yields. You obviously have to say, well, someone is short, who's long? Well, the long side at the moment are asset managers and institutional who are supposed naturally long. So that's where the long side is. But the leverage funds, these are obviously the guys with a relatively tight stop if something goes against them. So these are the ones we should look out for. But at the moment, they are definitely pointing towards higher yields.
Yeah, I guess the question begs, so one has to wonder how big is that speculative position relative to the size of the entire market. So it's tough to know when that level becomes a difficulty in terms of the risk of an actual squeeze.
Absolutely, but overall, it's when it's just been going up for that in that amount. We haven't seen volume go up in the same at the same pace, so it is quite an elevated position.
Great, and then of course the weak link when U.S. yields are rising and the U.S. dollar is rising are emerging markets. And we're seeing a big focus on emerging markets this week. We had that big Turkish central bank rate hike last week, 625 basis points. We saw a big rally in the Turkish lira. It managed to stick for a day. It's a bit weaker this morning. It's some interesting interference going on between Erdogan and a spat between him and a key bank in Turkey. Don't have the specifics on that, but track that story. We also need to see the Turkish lira sticking and staying stronger here. Otherwise, I think we're going to be straight back into the teeth of a new issue there. But elsewhere in EM this week, big focus on South Africa. We have a South African central bank meeting, a reserve bank meeting on Thursday. I think they really need to hike rates to encourage the stability in their currency after the very big long run lower in that currency. Unfortunately, the economy there is heading into recession or has post-recessionary GDP growth for the quarter, so that's a tough decision there. Actually, if you look at the expectations, we have a chart here of the South African rand. That around that 14.70 area was where we found support. That was the previous high on a daily closing basis, and 15.50 to the upside. Again, Thursday is the central bank meeting there, and EM's also eyeing China very much as we see that dollar CNY rate close to that 690 level. It's really not managed to go much lower. This broad concern across the world if China is allowing its currency to devalue. And of course, over the weekend, we have Trump banging the drum again on trade tariff threats, talking about another round of tariffs on 200 billion. So, and the Chinese market has been very weak, very heavy. We have a chart here of the CSI 300. Kim, you've been looking at this, we all are, because we have such pronounced weakness in the emerging markets, specifically China, relative to what usually gets the headlines in the U.S. market. So what's your interpretation of where we're trading here?
Well, as you can see, the China 300 and CSI 300, it's dipped below 3,200 a couple of times. It seems like there's a really strong support here. I looked at strength indicators this morning. Unfortunately, we don't have them on here, but they haven't really supporting this weakness, the latest weakness. So I think we could see maybe a little short-term bounce from here.
Okay. Well, that would certainly add to global risk sentiment if that is the case. And then on the commodity front as well, if we're supposed to be looking at economic indicators, copper is one of the ones we go to, Dr. Copper so-called. It's been weak for quite a while.
Yeah, it's been weak, and that has been tied in with the weakness we've seen in the Chinese renminbi over the past 3 to 4 months after the trade war really broke out back in the early summer. And if you look at the chart here, you can see basically high-grade copper. It's settled into a little bit of a range here, but looking at the whole move up from 2015, we're more or less retraced half of that. So it could indicate right now we are settling into potentially a 250, 280 range. As Kim mentioned, the technical is pointing higher for the stock index, but obviously we need to see any news on the trade front. And if we do see these tariffs being announced and China come up with a response to it, then the downside risk prevails at this stage. And
then on positioning, you have your positioning chart here. This is a roundup you often do on Monday because you get all that data in on Friday.
Yeah, and the update will be available on home.saxo within the next hour or so. But what it just basically shows is that it's just blue. It's basically saying that all the positions, the long positions right now is in energy, short positions are in metals and agriculture. This is really old. You can almost have really write Trump all over this because the energy sector is long because of sanctions against Iran. Metals and agriculture are short due to the tariffs and the trade war risk and EM growth concerns. And so basically energy is really the one that's holding it up. So Brent crude right now we've seen Brent and WTI trade near the highs, and obviously this week could be interesting once again because just last week we tested $80 in Brent crude. We have a meeting on Saturday with the OPEC and Russia where they're going to talk about the lifting or raising production potentially further to offset what's happening in Iran. But I think just on Brent it is really quite crucial level that we reach. So Kim, have you got any views on that?
No, true. Brent also seems to be the strongest one, whereas the WTI seems to be a little bit heavier. But as you can see here, 80 is really the key. It's tested at 4, 5, 6 times. So a break above this resistance that could really fuel another rally higher towards 90 maybe. Whereas if you look at the very steep rising trend line I drawn on the chart there, well, it's not the strongest support, but so we could maybe see a little bit of drop before it takes the trip up against the 80.
And I think if we break, then we're straight back to you, John, because then emerging markets they will be suffering even more pain.
Exactly. Yeah. This strong oil price is really putting the brakes on the potential for global growth. The big importers, look at India. The rupee is so much weaker this year. So the price in rupees has really gone up drastically. Turkey, forget about it. We're talking about in the order of 100% rise in prices for oil for the Turkish consumer in lira terms. So this is a big, it brings forward the risk, obviously, of a more global slowdown with this oil price as high as it is. Let's round out the day with our chart, not our chart, but our economic calendar. Not an action-packed day today. It is a Monday, but we have a few bits and pieces. ECB speakers out. And then up tonight in the Tuesday session for Australia, the RBA minutes. The key things I would like to point out this week. Wednesday, we do have the CPI from the UK, but that I think it's a real key week for US dollar and US yields. And then, of course, what is the weakest link there if those begin to or continue to go higher? And that is emerging markets. And how is emerging market confidence shaping up around the Brazilian rate decision? The real has not participated at all in the recent attempt at a relief rally and somewhat selective relief rally, I would say, in emerging market assets. And then the South African Central Bank, Reserve Bank on Thursday. South Africa widely considered one of the weaker links after Turkey in terms of EM. And then we have Norwegian Central Bank announcement on Thursday as well, and then some CPI data points up later in the week. And we're all waiting for the FOMC next week as the next U.S. link. And then, of course, all of our Brexit news, which is bubbling along. We had a Boris Johnson very interesting commentary out on the Telegraph, calling this latest attempt at a Chequers-style deal a, quote, car crash. Some very colorful language in that article. Again, we've talked about the risk on the Brexit front is from the domestic political scene, not on whether Theresa May and the EU can reach terms in that deal. We'll leave you with that for today, and we thank you. We'll be back tomorrow with another edition of the Saxo Bank Morning Call.